I think it's important to look at how the current sell-off is relative to some of the large sell-off we've seen over the past 2 decades. So trying to learn a little bit from history where the current sell-off could go. And what's interesting is that if you look over the past couple of decades and the large sell-offs, there are broadly 2 types. One that's associated with recessions and one that are not associated with recessions. In a recessionary scenario, you tend to have spreads widen a lot more, but then you have a pretty strong recovery and a noticeable recovery. On weaknesses where there's no recession, you tend to get many peaks and troughs as the economic uncertainty tends to drag on, and such uncertainties could last around 12 to 18 months. And that's a scenario that we expect. So from our perspective going forward, given all the lingering uncertainties, our expectations are we will see many peaks and troughs going forward. There could be opportunities to go long, etc. But overall, our view continues to be fairly defensive.
Okay, so we're not in oversold levels just yet.
So that really depends. So it's been a very kind of variable in terms of the parts of the market that sold off and the parts of the market that have held in. So for example, the Indonesia and India high yield market, the very high end of that part of the market, we feel as though they've sold off disproportionately. So we actually think that there's a bit of value emerging in the higher quality end of Indonesia and India high yield. But from an overall market perspective, valuation is still not at very cheap levels. We've had a correction, but if you look at it from the global financial crisis to now, we're still below 20th percentile in spread terms. So it's still towards the lower end rather than the higher end of where spreads have been historically.
You know, Ken, this I guess you could call it dislocation. I'm trying to figure it out, right? We're seeing equity steady out, but in the route earlier that we saw, yields still stayed high. And right now we're seeing a steady in equities, I know, but the 10 is still at 4.5%, which doesn't say recession to me. It says, okay, maybe higher inflation. It also says potentially, I don't know, maybe the U.S. has to pay more for people to buy their paper. What I mean, the 10 at 4.5, what does it say to you?
Potentially it says a lot of things. I think if you look at the rationale in terms of why some of the treasuries have sold off, you know, is it foreign selling? Is it because of risk premium? Is it concerns about inflation? Or is it a combination on all of those? And it's a possibility. So there's no clear answer to that. And the way we try to kind of think about it is a little bit more on the expectation that volatility for risk assets will stay elevated. So that remains key, right, to manage that volatility rather than to be kind of too fixated on the firm direction. And so that's why, you know, we feel as though investment grade gives you slightly better risk reward because that generally is a much lower volatile asset class versus the high yield. And so it's really managing that volatility is key.
When you take a look at spreads, whether they're high yield spreads or swap spreads, et cetera, are you seeing signs of stress in the bond market? Is there, bluntly, is there a liquidity issue?
The stress indicators have ticked up a touch. So if we look at the data from our US credit team, for example, they look at a variety of indicators. But if you look at, for example, like bid-offer spreads, yes, they have widened. But if you compare, for example, during COVID period, we're still way below that type of level. So what we are seeing is, yes, there's a moderate pickup in some of those stress indicators, but they are by no means at stretch levels and certainly way lower than previous kind of really stress periods, such as during COVID.